Hello and welcome back to Katie's Business Tips. Glad to be with you. Michael Lapede here in a small series about tax planning for business owners. And in this video, we're going to talk about day-to-day operations and how that affects your tax planning. Number one is every day when you spend money in your business, that is most likely a business deduction. Now, you might be buying assets or you might be, paying off old debt, but most things that you're purchasing or spending is a business deduction. And you can deduct any expense for your business that is either for running the business or that helps it potentially make a profit. Every expense. You can also deduct all costs associated with preparing and starting your business. So, if you're at the beginning stage and you're getting your day-to-day going and everything's getting started, well, there's could be startup costs maybe you already had. We want to make sure we track those, capture them, and write them off as deductions. We need to also look for creative ways to create deductions, right? So for example, if you have your own company and you're constantly going to the dentist and chiropractic and physio and buying glasses and all these things, why wouldn't you have an HSA, a health spending account or private health service plan that can allow the company to get a deduction and then you're not out of pocket at the end of the day, right? As an example. But you can need somebody look for creative ways to create those deductions if you're spending the money already. Remember that you can also deduct portions of expenses or portions of assets. So let's say you buy a video camera and you're like, I'm going to use this for video shoots on all my job sites. And then you go, but I'm also going to use it to go camping too as well with my family. That's fine. 50-50, no big deal. Prove that you're using it for business, not a problem. If you're using it mostly for business, just write off in the business, obviously. If it's 90%, it's substantial, that's fine. But you can do things partial. Home office, telephone, cell phone, vehicle. These are all things that can be part and parcel where you use part per personal and part business-wise. You just need a way to determine how you're tracking what's personal versus what's business. Now, deduct your home office. A lot of people are, well, how about deducting my home office? Because I'm using my home office day to day. Every day, I'm at my home office. I go to the other place. That's fine. And yes, you can deduct home office. Even if you have another location to go to, you probably have paperwork, computer, and a desk at your office and an office set up. That's fine. And how you're going to do that typically is take a percentage based on square footage. Here's the square footage of the room in my office. Here's the total square footage. I'm going to divide it, get a percentage. You can also do number of rooms. I have 5 rooms. I use 1. It's 20%. You can do it that way too as well. And then you're going to multiply that percentage times all the home expenses. If you're renting, rent and utilities. If you own, it's mortgage interest, property tax, utilities, insurance, repairs and maintenance, etc. So it's quite simple to write off that home office, but you don't have to do that till the year end. So just make sure on a day-to-day basis, you're just keeping track of everything. So at the end of the year, you can total it up, right? Now, another important factor of day-to-day operations is, you're constantly probably taking money from your company. You want to try to do that consistently, say once a month, twice a month, bi-weekly, semi-monthly, whatever it is. And you want to make sure that when you're taking the income, or the money, you know what it is. You've planned this in advance. Now, it can be a shareholder draw. And you have that plan that you're putting aside money for tax. We're going to do a combination of dividends and wages at the end of the year. That's fine to take shareholder draws. It could also be that you're already taking a wage or a bonus and you know it. It's on payroll. It could be, that you're taking dividends and these are dividends and you know they're dividends. But these are the main 3 ways you are taking money out, and they're all taxed quite differently. And wages are going to be taxed the highest because they're a deduction from the company. Dividends are going to be taxed lower because the company paid a portion and therefore you're paying lower tax because the company paid some of the tax. And shareholder loans are non-taxable, but you have to either pay them back or claim them as income. However, a lot of times people will put assets and money and paid for things of their company and they're really just getting paid back, and that's okay. That's non-taxable. Shareholder loans have up to 1 year after this current year end you're in to pay back or claim as income. So a lot of people, what they'll do is they will draw shareholder loans, every month, put aside some for tax, and at the end of the year, we just claim what we need to claim for dividends and wages. And that's a way to do it. And at the end of the day, we always want to maximize our shareholder loans. We want to always make sure that we're looking at what shareholder loan do I have? Do I owe shareholder loan? Does the company owe me money? Is there anything I can do to maximize that shareholder loan? Because it is a powerful tool in tax planning that you will be dealing with on a regular basis. Any questions, we'd love to hear from you. Thanks for being a part of our business tips. Post in the comments below and we'll see you in the next video.